Hello everyone, welcome to today's technical analysis lesson from Ichimoku.co. Please remember to visit Ichimoku.co to look at other lessons, take a look at the free video analysis that's there, have a look at the membership that's available and providing video analysis daily, not just on Ichimoku, but varying much wider than that in general technical analysis, pivot points, Ichimoku, candlesticks, Fibonacci, all sorts of techniques, and we just don't limit ourselves to Ichimoku, but Ichimoku is the basis of how we determine our trends, but then apply other trend and management tools, technical analysis tools to the markets that we're analysing. Today I'm going to look at chart pattern recognition and how we can identify some chart patterns. This is an introduction to chart patterns, and specifically look at a certain type of pattern, and that is the symmetrical triangle. Now, very important with chart patterns is to understand the underlying basic structure of any market, and markets don't trend all of the time. They trend and then they form these sideways congestion areas, and then they trend again, and markets do that time after time in a cyclical nature. Now, as traders, it can be to our benefit to identify when the market's trending and when the market's not trending. Most of the trading strategies that traders adopt are trend trading strategies. One of those trend trading strategies is trading chart patterns. So what you do is you identify the trend, you identify the pattern, then you trade the trend that follows from the pattern or tends to follow from the pattern. Now, these sideways movements that the market forms after the trending activity is what we call trading ranges, and these traders are places where accumulation or distribution takes place. So either one of the market participants are building positions in the expectation that the market is going to move higher, or the market, one of these sides, the buyers or the sellers, are accumulating positions or getting rid of positions in a trading range in the assumption that the market is going to fall. Now, many of these trading ranges form shapes or patterns that are easily recognized, and not all of them are easily recognized, and what we'll be looking at here are a stylized idea of how they may look, in particular the triangles. But remember that even though we can give all the theory and understand these patterns, they don't always form perfectly, so we need to be flexible in our interpretation of them as well. But what tends to happen after these patterns form and after we see the breakouts away from the patterns, it tends to be fairly predictable, and combined with good money management and good trading strategy, placing an order and then placing a stop, we can actually make use of those in returning profits to our trading plan. Now, very, very important is that we need a trend before we can identify a congestion area or identify a pattern. And as I've mentioned before, markets move from trending phases into congestion phases. If we look at a chart and we see a congestion area but we don't see a trend leading into it, then we don't have a pattern, and it may be very, very difficult to trade that type of pattern. Now, very often and over the years, I've seen a lot of people marking down a congestion area on a chart. They say, oh, this is a head and shoulders pattern, but there's not a trend leading into it. Head and shoulders patterns, or any of these patterns, do not exist in isolation without a trend. It's impossible for them, and it's very, very dangerous to trade them if there is no prior trend. So we must have a trend prior to any of those congestion areas, to any of those patterns forming. And yes, the head and shoulders pattern is one of these patterns, just as the symmetrical triangle is. Always important, and never forget that you are really flirting with danger if you think you're going to trade a pattern that you identify that's formed without a prior trending price action. Now, there are two types of patterns that we can identify, or perhaps there are three. Now, the first is a reversal pattern, the second is a continuation pattern, and the third is one where we either have a reversal pattern or a continuation pattern. So we have patterns that can have a dual role. So they're not really a third type, they're either one of the above two. So here's what a continuation pattern looks like, and here we have the trend leading into the congestion area. And always we need that trending price action. The market forming a series of higher peaks and higher troughs. We have the congestion, and then we have the breakout after the market leaves the barriers of the congestion area, a close above the barriers, the upper barrier here in this case in an uptrend, and we see further development of the trend to the upside. That's what we call a continuation pattern. Now, this could also be to the downside in the opposite configuration. I'm just going to concentrate on uptrends here, but they do form the same but opposite in a downtrend. So once again, an uptrend, congestion, a close up above the upper barrier, the trend develops to the upside in the same direction as the prior trend leading into the congestion, and that's a continuation pattern. For a reversal pattern, we have the breakout in the opposite direction to the prior trend. So here we have the trend leading into the pattern, the market making a series of higher peaks and higher troughs, an uptrend in place, a congestion area, the market closes down below the lower barrier and the trend develops to the downside in the opposite direction to the prior trend. That's a reversal pattern. Now, there are some general characteristics that we may see within these reversal patterns, but not always, and it's important to remember that we don't always see these characteristics, but the reversals tend to form a little bit slower and they tend to be a bit larger. So but they don't always, so just remember that. Form slower over a longer period of time, that means, and they tend to be larger. They can be larger in terms of magnitude or in terms of the period of time as well. Continuation patterns, however, tend to be forming over a quicker period of time and tend to be a little bit smaller in range. And if you think about it, in a way, thinking of continuation patterns, that's where we have the market participants that were forcing the price action up in the trend taking a little bit of a break and starting to accumulate more positions, and then we have a vacuum of positions that they want to try to accumulate, and they have to bid higher prices. The opposite for a reversal pattern, where we have the participants that were forcing the market up are taking profits, they're getting out of their positions, and tends to be distribution. Then we have the sellers looking in terms of a previous uptrend, looking to find buyers. We don't have any more buyers around, so they tend to have to bid lower prices, and that's how the trend develops to the downside. Now, as I've mentioned, sometimes some of these patterns can occur as both a reversal or a continuation. And that's where we start to think about triangles. Triangles have a dual role. They can be either continuation or reversal patterns. Now, there are three types of triangles. There's symmetrical triangles, ascending triangles, and descending triangles. And when we draw the barriers of them, they tend to form slightly differently. Now, as I've mentioned, triangles can appear as both reversal patterns or continuation patterns. They do tend to be continuation patterns, however. And one thing to be aware of is that we also have pennants that can form. And pennants may be shaped in a very similar way to the triangles, but they tend to be much smaller in nature. They form very much quicker, and they form over a very much smaller range, and are much more dynamic in terms of how fast they move. So don't confuse a pennant pattern with a triangle, the symmetrical triangle, because we have very different ways of managing those trades and very different ways of determining the targets. So here we have what a symmetrical triangle looks like on the right hand side, a series of them. we have the trend in this top left hand corner. We have the trend leading into the pattern. We have formation of the trading range, and if we draw in the peaks and troughs within the range here, we see that the peaks and troughs converge. The highs and lows, or peaks and troughs within those that congestion area, converge, forming a triangle shape. It's always important to draw the barriers, and it tends to highlight that convergence, and we also use that in our trading strategy. So here we have the trend leading in, the congestion, the convergence of the peaks and troughs, and then the breakout in the direction here to the upside. Now, very important if you're new to trading, to draw in the swings in your price action, and it tends to make it easier for you to identify patterns when they form. It's a little trick that I think all people who are fairly new to technical analysis, and even some of those that have been using TA for some time, if you're drawing those swings in all sorts of price action, it tends to be easier to identify these congestion areas and what type of pattern they may be. Now, just remembering that symmetrical triangles can either form in an uptrend or a downtrend, and here we see on the top in these diagrams them in an uptrend as a continuation or a reversal pattern, and then in a downtrend here on the bottom as a continuation or a reversal pattern. They tend to be continuation patterns, however, these symmetrical triangles. They tend to continue the trend that was forming prior to the formation of the congestion area, but not always. The important thing is to wait until the pattern is confirmed, and confirmation of the pattern is a close either above or below that lower barrier. Now, one thing to remember as well is that, and this is not always, but very often a large symmetrical triangle where it's very, very large in relation to the size of the trend leading into it, they tend to form as reversal patterns, and they tend to be significant tops. So what we have is price action leading into in trending into a large congestion area, and if we think about it, a large symmetrical triangle is going to be an area of quite a lot of indecision in the market, because we don't have that strong trending or directional price movement that we had before. We tend to have a volatility in terms of moving higher and then lower, and the swings within the move tend to be quite large, and that's what forms a large symmetrical triangle. As I've mentioned, when we see formation of the triangle, we never try to preempt them. We never try to get into a trade before they've been completed. Completion of them is either a close above or below the upper or the lower barrier of the congestion area of the triangle. Now, also important to identifying them, and as traders it's all well and good to go and do the analysis and identify, but it's also how we trade these patterns after we've identified them and after they've completed. And this is how we trade those that are continuation patterns. So here we have the trend leading into the pattern, a series of higher peaks and higher troughs, uptrending price action. We have congestion, we have the convergence of the peaks and troughs within the congestion area. We draw the barriers, and then we have the close outside of the upper barrier. Once we have that close outside of the upper barrier, the next day we enter a long position in line with the prior trend leading into the pattern. So once we have the close there, we know that it's been identified as a continuation pattern. We place our order to go long above that area there, and we also at the same time place a stop loss order directly on the other side of the where the trade broke out, where the price action broke out, directly on the other side of the lower barrier there. So this would be the opposite for a downtrend. I'm only showing you what happens in an uptrend. So once again, once the market closes above the upper barrier, we enter long, and we place a stop on the other side of the barrier, or sorry, of the lower barrier. For a reversal pattern, we do the opposite. Let's identify this uptrending price action here, congestion, the peaks and troughs converging. We have the close down below the lower barrier here as we've drawn it. It identifies this to be a reversal pattern. we go short as that occurs, and we place the stop just on the upper side of the barrier drawn above the peaks, the opposite to the lower barrier. So once again, trending price action leading into the congestion area, the close down below the lower barrier, we place our stop for the short position that we've entered up above the upper barrier. Well, that concludes the introduction to price patterns, and in particular the symmetrical triangle. There are more lessons on the Ichimoku.co website. Please feel free to go there and have a look for them. If you look in the categories of all of the posts, you'll be able to find them. Also take a look at the free daily analysis that's available there, and also consider joining up as a gold member for further detailed analysis.